Well, welcome. My name is Elizabeth Stevens. I am CEO of the Downtown Mobile Alliance, and we are thrilled to have this great crowd here today to talk about downtown housing. It is something that is near and dear to my heart as a downtown resident. I see some other downtown residents here, Jerry, and certainly want to encourage more of that in an accelerated way, frankly. And so that's why we're here today. I want to ask Fred Renfrey, who's worked on this project, to give you a little background and to introduce our speakers. Fred?
Welcome. As she said, my name's Fred Renfrey. I'm the Director of Downtown Economic Development for the Downtown Mobile Alliance. Pardon the peppermint in my mouth, but I'm getting over a cold, so I don't want to project my cough. But so welcome to If You Build It, Will They Come? So what brought us here together today? The Alliance recently went through a 5-year visioning process, and after surveying property owners and stakeholders, the Alliance board said that a downtown economic development success would include 2 major action items around residential development. Those are a better mix of housing options to include single-family, townhome, multifamily, and artist live-work housing, and 1,000 more housing units downtown. So, first, we got to get busy. So first step, let's work with Zimmerman Volk, Lori Volk here, who is here today, will talk to us about the residential demand analysis that she performed. And the next is to understand our market, assess the opportunities, strengths, and weaknesses, and finally convene workshops like this here today to talk about the matter for the brokerage community, the investors, the downtown residents, developers, etc. So appreciate you all coming. First, I'd like to introduce Lori Volk. She's the co-managing director of Zimmerman Volk, and she performed a 2007 downtown residential market demand analysis, and she's here today to talk about what her research shows in 2014. And it's been helpful that we had a new census to go off of, the 2010 census, to base her research off of, and then it's what happened in pre-2007. Is we started over, so we're starting from scratch. So now I'd like to introduce Lori Volk to talk about the downtown residential demand analysis.
Thank you, Fred. Thank you, everybody. It's great to see everybody here this afternoon. I got in yesterday and walked around a little bit, and I was like, oh my gosh, a lot of stuff is happening here, which is always very encouraging for market analysts to see that things do happen after you leave and it doesn't just lie on a shelf. We have a very specific kind of methodology that we developed and have refined over the years. We call it target market methodology. And what it does, okay, thanks. And what it does is look at market potential and not demand, sorry. We use the word potential because when we first started doing market analyses in the late 80s, early 90s, a lot of cities were not gaining population, they were losing dramatically. And it's very hard to project any kind of growth when the historical pattern has been one of loss. But we understood that in any market area, no matter how poor, there are always households that are moving from one place to another. And if you can understand who those households are, what their financial capabilities are, what their housing preferences are, you can develop housing that will respond to those characteristics of the target market households and have a very successful project. And we have found over the years that we were indeed correct in that assessment, and we have found the methodology to be a very powerful indicator of market. And that's very helpful when cities are contemplating whether to actually try to invest in downtown housing. Our studies answered all of these questions, and I will explain what they are here in Mobile. But the last 2 items in particular, what the market's willing and able to pay and how fast the units will be absorbed, are 2 very key pieces of a pro forma analysis for a developer about to undertake a downtown project. So we hope that this study will be very helpful to potential developers who are looking to do new downtown housing. And we've certainly learned that it has been so in other cities. We've done more than 65 downtown housing market analyses, and in every major city in the region. Certainly we've done studies in Pensacola, in Mobile, in Montgomery, in Birmingham, in Jackson, in New Orleans, Baton Rouge, Lafayette. We get all over, and so we really do understand the region. This is the study area, which is the same as it was back in 2007, but you can see it's the classic loop. Looking at what's changed since that update in 2007, which of course we released that update, and then the world crashed. This housing market collapsed and the stock market crashed. So it is now 6 years after that crash, and we are seeing that even though this nation lost trillions of dollars worth of value of housing, it is now the housing market is slowly starting to come back. And in many parts of the country, it's come back roaringly. In other parts of the country, less so. But we see even in the worse off cities that there is a gradual increase in housing value, which is encouraging to all those people who have been underwater for so long on their mortgages. Credit, however, still remains tight for both builders and for potential home buyers. When even Ben Bernanke can't get his loan refinanced on his house because he is self-employed, you know that the situation has really gotten absurd. Energy costs are still a concern, even though the cost of gasoline is now going below $3 a gallon in most parts of the country. As you can see, when we took this picture, everybody was fuming that the price of gas was $2.33. I don't know if you can even remember those days. But certainly we have understood that if you have a really hot summer in the south or a really cold winter in the north, energy costs have become a bigger and bigger segment of a household's budget. So what's happened here to the downtown housing market? Well, the annual market potential is up 14%. You know, we look at how many households are moving within and to the city of Mobile, and how many of those are the kinds of households that look to live in downtown. And now, over the next 5 years, an average of about 2,225 households represent the annual potential market for downtown housing. And that's up from 960 households in 2007, which that's a considerable increase. And I think it's really an optimistic note for all of you that might be considering doing downtown housing. What we've also learned is that migration patterns have stabilized at pre-Katrina levels. After Katrina happened, there was a huge influx of households here, obviously from New Orleans and other stricken areas. Now it's back to the same pattern that we saw pre-Katrina. So the city of Mobile represents about 46% of the market potential, and the county about 15%, and Baldwin County and the balance of the US have gone down proportionately. However, because there is still a larger market than there was before, that the difference in percentages is really negligible. There is, however, a notable shift in housing preferences. And this is not just something that's happening in Mobile, but it's happening in downtowns all across the country. We saw that here, from last time, 2007 to today, the market preference for rental apartments has now 50%, up from 35%. Again, this is something that's happening all across the United States and is driven by a variety of factors. Condominiums for sale lofts and apartments is now 14% of the market, which is down significantly from 29% in 2007. And that is in part because of the lack of ability to get a mortgage for condos and the very difficult time a developer would have trying to build a condominium building. Row houses, townhouses, has dropped to 18% of the market from 24%. And single-family detached urban houses has gone up to 19% from 12% of the market. So you can see The for sale market has moved more towards single-family detached houses, which is definitely fee simple ownership, which is much easier to finance, as opposed to condominiums, which are condominium ownership, and the townhouse row house, which can be either condominium or fee simple, but for the most part tend to be condominium ownership. So have the markets for new downtown housing changed at all? Well, it's still dominated by the two largest generations in American history. The baby boom generation, which for a long time was the largest generation in America, but unfortunately, as what happens as a generation ages, some of them begin to die. And so it's now 77 million for all those people born between 1946 and 1964. Now, we usually have a series of slides that talk about the baby boom and the huge impact they've had on the housing market and on every possible institution that they've passed through, from educational institutions to universities and to the apartment market in the 70s and 80s and to the single-family detached market in the 80s. And it's been totally amazing how every market changed as baby boomers moved through it. Now, however, the people driving the bus are their children, the millennials. Now they're the largest generation in America. They're born between 1977 and 1996, and they are very different in many ways from their parents. They share a lot of the same housing preferences. They want to live in downtown, as do their parents. But apart from that, they are very, very different. They're delaying marriage. They're delaying having children. They're not as interested in automobiles or in driving. I mean, there's been a significant drop in the number of young people under the age of 21, between, I guess, 15 and 21, that have driver's license or are even interested in getting one. It's quite a significant difference from predecessor generations. So as a percentage of the market, young people are now 54%, up from 52%. Their parents, the baby boomers, are now 31%, down from 32%. But again, because the pie is bigger, that smaller percentage still represents more households than before. And the family market, which is very typical in most of the cities that we do studies, is now 15% of the market, down from 16%. So we also updated what the current rents and prices are in downtown and in Midtown Mobile. We looked at 27 different properties just to find out what the current rents were and what the current occupancy was. And current general rent ranges fall between $525 and almost $2,000 a month for a 440 square foot studio to an 1,850 square foot two-bedroom unit, which is a rent per square foot range of about $62 to $1.48, although I would say that most of the units are within the $1 to $1.20 range. We looked at, because there are no new properties selling condominiums, there are leftover units that either didn't sold or are now being sold or resold. There were 35 of those listed in August when we looked at the resale market. And the listed prices ranged between $131,000 to almost $1 million for a 612 square foot one bedroom to a 6,600 square foot single family house. And that per square foot range is 88 to 226. But again, most of the listings were between, I'd say, $125 and $175 a square foot. So clearly, one of the key things to understand is where is the potential market in terms of what they can afford. So when you look at the rental market, and based on paying no more than 30% of annual income for rent and utilities, we then gridded out all the target households that represent the potential market based on their incomes. And each of the target groups have a different bell curve that they follow. And the result shows you here what the different percentages are of the housing market for the rentals that can afford rents, say, between $500 to $750, all the way up to 2250 and up, you can see that the heart of the market is really that 500 to 1250 square foot. Although, surprisingly enough, almost 30% of the market is for units priced above $1,750 a month. So what that says to me is that depending upon the kind of housing you're proposing to build in terms of rentals, you need to be very careful about who you're targeting and what the unit sizes and rents should be in order to capture the heart of the market. What we propose, based on the housing preferences and unit type preferences and the financial capabilities of the target households, are monthly rents ranging between $500 and just under $2,000. And we would even suggest introducing what we call a micro unit, a micro loft of about 350 square feet to 3-bedroom units of 1,450 square feet. Now, this micro unit is a new unit type that is actually doing very well in many cities across the country, including small cities like Providence, Rhode Island, where basically the general rent per square foot is very similar to here. A developer recently undertook the redevelopment of the arcade building, and in it he put 44 micro units ranging between 250 and 350 square feet, and the 350 square foot unit was a 2-bedroom. And you think, all right, he started out charging $500 a month rent for the 250 square foot unit. When you figure that out, that's $2 a square foot. Now the rent on the 250 square foot unit has gone up to $575 a month. He has a waiting list of more than 1,000 people. It's clear that there is a real market out there, particularly for young people who really want to live downtown but cannot afford a $1,500 a month 1-bedroom. And they don't really have a lot of furniture, they can't afford it. They just need closets for their clothes and a place to store their bike. And the rest of the time, they're going to be out in downtown, which is exactly what you want. So we really recommend that you investigate those smaller units. We think that they would work very well here. There seems to be a sizable market of young people that would definitely rent these. Of course, they have to be very cool. They just can't be 4 walls. But I'm sure that you can come up with something. Our proposed rent per square foot ranges between $1.11 and $1.53, with a weighted average of $1.30. Again, we looked at the potential market for condominiums, and here you can see that there's also a skew towards the $200,000 to $300,000 range in terms of prices. In this case, we looked at spending with a 20% down payment, spending no more than 25% of annual income on mortgage, utilities, and insurance. So clearly the very high-end market is only 8%. And if you were doing, say, a penthouse, that's what would qualify in that department. But again, the heart of the market is between $200,000 and $300,000. We would recommend base prices ranging between $125,000 and $350,000 for units containing 750 square feet, an open hard loft. Again, that would be very appealing to a young person, and 1,750 square feet. The price per square foot ranges between $155 to $208, but the weighted average would be $189. We did the same thing for the 395 annual potential townhouse buyers. And again, it's slightly skewed, slightly higher, because what we have learned over the years is that as the price range goes up, there's a slightly different mix of households that represent the potential market. So here you can see 250 to 350 is really the heart of the market, and our recommendations run between $195,000 and $255,000 for 1,150 square foot 2-bedroom units to 1,550 square foot 3-bedroom units with an average of $165 to $170 per square foot, weighted average of 167. And finally, detached houses. There were 415 annual potential buyer households of single-family detached houses. And you can see, again, the range of where all of the buyers fall. Again, 250 to 350,000 and 200 to 250,000 is where the core of the market is for the detached houses. Now, people always raise the question that, well, existing houses are in 100, 110, 120 per square foot range. Why would anybody pay this much higher value per square foot? And what we found is that there's a whole segment of the market that only wants new construction. The charming old houses you have here are not what they're looking for. They want something new so they don't have to worry about replacing the boiler or fixing the roof. They just want to walk into a brand new house. And they are typically willing to pay a much higher price per square foot. We would recommend base prices between $210,000 and $275,000 for 1,300 to 1,800 square foot units, with an weighted average of $158 per square foot. So what does this mean in terms of absorption? Now, we've learned over the years that you can't capture 100% of the annual potential market. Theoretically, you could, but I have yet to see a city that actually gets close to the capture of the potential market, which we generally forecast for rentals at between 15 and 18% of the annual potential market, and for sale units between 10 to 12% of the annual potential market. If you can achieve those capture rates, this downtown would be able to support between 280 and 334 new market rate units per year, made up of 167 to 200 rentals, 31 to 37 condominiums, 40 to 47 townhouses, and 42 to 50 detached houses. Now that sounds like a lot, and it is a lot. It actually means it would be more than 1,500 new market rate units in the downtown over the next 5 years, a 50% bonus over what you have outlined as your goal. And what it represents is a tiny fraction of the annual market potential for the city as a whole, because we keep scaling it down so that it's now actually less. This number, the annual market potential, is actually less than 1% of the annual potential housing market for the city as a whole. So we think it's very doable. We think you could do more, but we certainly believe that 1,500 new market rate units is very achievable over the next 5 years. Thank you.
Thank you, Lori. We're going to have Q&A at the end from all three panelists, so we'll hold questions till then if that's okay. You know, when I joined the Alliance about 6 years ago, you'd read about trends from experts about the changing in demographics, and I always said, well, you know, I kind of thought that the baby boomers moving into downtown was for other markets, and then you see baby boomers retiring to downtown, and I was proven wrong. We see it all day, but anyway, that's a takeaway for me. So now I'm going to introduce Bo. Bo Fleury is the managing director for Rock. He has 10 years of multifamily brokerage and advisory experience. And so he's going to share with us some lessons learned from other communities about different project types and see what we can learn from Bo. Thanks, Bo.
All right. Thanks, everyone. Let's see. All right. Let's go here. All right. Thanks, everyone. Thanks, Fred and Carol, for putting on this event, asking me to present here. My name is Bo Fleury. I'm with Rock Apartment Advisors. We are a Birmingham-based multifamily brokerage and advisory firm. We've been in business since 2003. We've got a 6-person team. We've closed $1.8 billion in multifamily transactions since 2003. We concentrate in the deep south markets from Louisiana to East Tennessee and the Florida Panhandle. So we're excited to be here. What we see across the market in terms of just the multifamily space in general, it's very active. As Lori mentioned, it's a rent first mantra right now, and it's certainly fundamentals have greatly improved since the recession. Transaction volume is at an all-time high, and one common theme we're seeing in most markets that we cover is the push to live downtown. And so what I'm going to do in this presentation, we have a report that we survey about 7 markets across Alabama, Florida, and Tennessee. I'll run through our most recent survey from June of this year for Mobile, and then we've selected a handful of new either development or redevelopment projects in comparable markets in the Deep South here. So I know we got some thirsty people here, so I'll try to do this quickly. All right. Let's see. All right, so I'm just going to walk you through some of the fundamentals in Mobile right now. Pretty market is overall healthy. We saw that Mobile and Baldwin County had some rent growth. Baldwin County has been stronger than Mobile. They grew about 2.4%. Their effective rents, Mobile effective rents were up 1.2%. The market as a total is up 1.5%. Mobile occupancy has been flat, about 90. It's roughly 90% versus Baldwin County has been very strong. 2013 occupancy rate was 95%. 2014 it was just under 97%. Class A rents for Mobile were up 2.2%. The occupancy for the Class A units was at 90%. Baldwin County occupancy for Class A apartments was close to 98%. It's very strong, and the effective rents were up just under 4%. So Baldwin County is really seeing a very strong apartment market. West Mobile had a lot of new deliveries a couple of years ago, which kind of softened up the market here, but those have been absorbed and slowly coming back. So this chart here is just a 5-year kind of synopsis of the blue is going to be your market rents, the red bar will be your effective rents, and then the line will show you the occupancy trend for the market as a whole. Run through just some sub-markets here. This is a map of how we break it up. You'll see there's the West Mobile sub-market is west of 65. We split up Baldwin County in kind of an eastern shore and a south Baldwin County sub-market. Again, Baldwin County has been very strong. A lot of new people moving to the area. We're seeing one of the things you hear as a common theme from the apartment managers there, people that are moving that are new to the market, the Mobile area in general, are moving there because of the school systems, seeing a lot of empty nesters move there. It's kind of a hidden demographic you're starting to see more and more of across the board in the multifamily space. This is in line with our presentation here. The Midtown and downtown market's done, really tightened up here. There's been a few properties that have traded and have been repositioned, and so that's impacted the numbers there. Midtown effective rents are up 2.6%. I'll walk through some new construction. It's been relatively quiet in the Mobile market. In Mobile, on the Mobile side of the bay, the most recent Class A deal, which is under construction now, is Parkside at Cottage Hill. It's a 240-unit asset built by Eastland out of Atlanta. They're about 60 days from getting their final CO. Their rents are about just over 90 cents a square foot. It's kind of A- product. Good, a little bit right off of Cottage Hill Road. On the Eastern Shore, it's been very quiet on the new construction there. They had 2 projects delivered over the last 18 months. It was by Gateway Development, Palladian at Fairhope, and Palladian at Jubilee Ridge, which is in Daphne. It's a 63 unit and 106 unit project. It's kind of a unique product that was townhouse looking, single 2-story, but townhouse units, kind of a neighborhood setup, but at least extremely well. This is just a kind of chart summarizing. At the bottom, you'll see there's 1,400 units in the development pipeline. It sounds like a lot. Not all of those are going to get built. There's one deal up over in Spanish Fort that's 140 units. That's probably most imminent, or would be the first one to start. It's a single-story deal in Spanish Fort. Spanish Fort's really backing off the density as far as how many units they can build per acre. That project will be about 6 units an acre, 2 and 3 bedroom units. Trying to go after the family or empty nester that wants a garage. So here's some sales over the last 12 months or so. It's everything. Mobile's been pretty active, $133 million in transactions. We unfortunately didn't do all of these, did some of these. But it's anything from Class A product to Class C. Class A market along the Gulf Coast, cap rates are in the high 5s to low 6s, depending on the location and quality and whether or not you can put new debt on the asset. Most of the distressed inventory that everybody was chasing after the last 3 or 4 years ago has pretty much been cycled through the market. Okay, so the reason we're all here, who thinks downtown multifamily development can be successful in Mobile? Raise your hand. Okay. So this was a pretty exciting, the more we dug into this, there's a lot of good examples here, and most of them you'll see, all of them it took one person to go do one project, and it ultimately led to more. And all of these have been very successful. We're going to start in Tuscaloosa, downtown Tuscaloosa. Was not much in the way of multifamily in downtown Tuscaloosa. The first project is going to be the Riverfront Village. This was a property that was initially planned to be about 300 plus units of all multifamily. It's on a 7.6 acre site. There's an old Chevy dealership near the river. The first developer could not get it approved by the city. And so a group out of Atlanta took over. They went back, dropped the unit count down to 200 units with about 40,000 square feet of retail. And city approved it. They started it. It's finishing up right now. It's leasing. It's kind of missed the mark timing-wise for students this year. But anyway, it's going to be a good deal. And the way it was received, it has spurred other developments in the downtown market for Tuscaloosa. So the next project is an example of that. This is it's now called the Tower Apartments, but before that it was one of the oldest, tallest buildings in downtown Tuscaloosa. I believe it still is the tallest building in downtown Tuscaloosa. It was purchased by a group out of Memphis for $4 million in December 2012. They were able to secure some historical tax credits for about $2 million. You'll see a lot of these redevelopments are funded with a portion of these. It's mostly vacant. On the bottom floor, there was a PNC Bank who was a tenant. Everything else was vacant. So they decided to go in and on the top floors put 106 units of studios, 1 and 2 bedroom floor plans. They are very nice on the inside, and they've got a good amenity set. PNC is still on the first floor. I think the first 2 floors they occupy. And there's a law firm, I believe, on the 3rd floor. The commercial rents are near $20 a square foot. The rents for the apartments are well over $1 a square foot. So getting some very good rents there. Just about finished with the project. They're 85% occupied as of last week, and they're not going to have any problem getting to 100%. So it's been a very good project for them.
Who's living there?
So I meant to tell you that. Okay, so that is not a student deal. That is a young professional, empty nester type tenant. No students, I believe, are living there at all. So. All right, we'll go up to Huntsville, and Huntsville's got some very interesting projects going on there. First one we're going to talk about is the one that got it all started. This was called the Belk Hudson Lofts. It was the old 1920s department store. Sealy out of Tuscaloosa was able to assemble 3 properties together. Most of it was the old department store. It was the first private development in downtown Huntsville in decades. So they went in, basically left the walls there and kind of built up. It is a really neat project. If you're ever in Huntsville, you need to go check it out. It's very, very good. Turned out really well. So it's got 75 units for apartments. There's no commercial space on this one. It's got 1 underground level of parking, 1 ground level parking. The city is helping them maintain this brick exterior. Some of that's the original bricks it's costly to maintain. So this will be one of the many examples where you have the city helping out in some way, shape, or form, whether it's with parking, building a deck, doing a ground lease on some land. This project is very well received by the market, leased up extremely well. It stays close to 100% occupied. And their rents are about $1.10 a square foot. So that was the first one in Huntsville, and that spawned this Artisan at Twickenham Square. It's part of the Twickenham Square mixed-use project. I don't know if you can see this picture here, but on the left, that's a 1950s 2-story brick public housing, low-income public housing property. The city built other affordable properties around the city, and they relocated those tenants. And so this is a $100 million mixed-use project. Bristol out of Nashville is doing the residential component. It's a 264-unit Class A apartment community. It's mid-rise. The city built the parking deck that the apartments can use, and also the retail portion. There's going to be a Homewood Suites. The Publix is already built. There's a 5-story office tower, and I believe some condos. The rents there, these are the highest rents ever seen in Huntsville. It's right around $1.50 a square foot, which is Huntsville's never seen that. Bristol, their focus is building these infill projects. They're very successful. They turn out really well. They're about to start one in Birmingham. They had some institutional equity. Northwestern Mutual do the debt and equity for them on this deal. So that project is finishing up, and this one right here, the Big Spring Square at Spring Park, was just announced. The city is owned or bought a Holiday Inn site. It's roughly 6 acres. They're going to tear it down, and it's going to be a $70 million mixed-use development. Really exciting deal. It's 200 units of apartments, some retail and office, a parking deck. The city's also contributing and doing some streetscape work to enhance the surrounding area. So again, this property and the one we'll see after this one, another Sealy deal. The rents for these in-town properties in Huntsville are 30 to 50% more than you would see at a Class A deal, garden style type development in Huntsville. So both of these projects, Belk Hudson, Big Spring, and this deal, the Avenue, would make the total unit count in downtown Huntsville over 500 units. So still not many units downtown there. So this is another Sealy project. They're, I think, close to getting it approved. It's close to 200 units. It would be a mixed use deal with retail on the bottom portion, about 21,000 square feet. It's a small site, 2.7 acres. It's a ground lease. Basically, they have it's a 50-year ground lease with an option to purchase it. The owner can purchase it after that. So another exciting deal, I believe the city's also spending some money there, about $2.8 million on some streetscape work around the site. Okay, on to Montgomery. Montgomery's has some similar characteristics to downtown Mobile. There's a lot of old historic buildings, some small sites. It's hard to go in there and build, 250 units. There's one project there that's not really in downtown. It's a couple blocks over, right near the interstate. It's 120 units. It's under development, but they have the supply. Downtown Montgomery, nobody really knew anybody's living downtown. What happened is in the 05, 07 mark, when everybody's building condo conversions, some people bought buildings to renovate them and sell them as condos. It flopped, and so they rented them out, and all of a sudden they had 120 units that were 100% occupied, and they were getting rents between $1 to $1.80 square foot. So here we are today, and there's several projects have been converted. The city's helping out in condemning some sites and selling them off to developers. One of the most unique projects in the market there is called the Market District. It's a Foshi Properties Development. They're a Montgomery-based company, very well respected. They do a great job. So this is basically along Dexter Avenue in Montgomery, which goes to the Capitol there. Foshi owns a handful of buildings along one side of the street, so their portion, they're projecting to have 50 lofts, about 40,000 feet of commercial space, 40,000 feet of retail space. This isn't all going to happen at once. It's kind of piece by piece. And then there's some other developers who own sites on the other side of the street and along Dexter Avenue that are kind of falling into place as well. So, I asked Foshi, what was the key thing about this site that made it work? And he said, number one, we're going to have a weekend pedestrian market, and the thing that's going to make the whole development, the whole street work, is they have 3 public parking decks located within 1 block of that whole area. So they've got a few buildings completed already. They've been leased up. They stay full. The commercial space is leasing up really well, and so they're extremely excited about that project. All right, Chattanooga. Downtown Chattanooga, they invested, I think about $15 million in the 90s in downtown Chattanooga, and they are leaps and bounds ahead of all of the towns we're talking about in terms of what they've done downtown. But the 2 projects we'll talk about are good examples of, first one is Cameron Harbor. This is along the Tennessee River, and basically you have, go back up to the map here. It's over here on the west side of this main highway here. That was an old Vulcan Materials site where they would offload gravel barges from the river. And this was a 10-acre site that a group from Nashville bought. And there was another developer there that had another piece tied up that he was going to do condos on. And so what they've done is kind of collaborate on this deal. It's underway now. It's about a $100 million project. The city is funding a river walk to go basically from that main highway all the way to the site. So you'll have kind of a walkable way to get downtown from the project. So a really cool deal there. They're going to have about 235 mid-rise apartments, some cottages and single-family homes on the development, boat docks and marina. Should do extremely well. This is a property that was the first mid-rise apartment or mixed-use development in downtown Chattanooga of size. It was 100 units, or is 100 units. Basically, there was a daycare business where this property is built. They knocked it down, and they said, we're going to build this property. We'll sell you your space back. And somehow or another, the city owned a portion of the land, which they leased back to the developer. That was financed with a HUD 221D4 loan. It sold in October for $15 million, $150 a unit, which is a huge price. The rents are about $1.40 a square foot. It's purchased by a private REIT out of Nebraska, and it was developed by a local developer. So, very good story there. Really nice property. Again, first large development in downtown Chattanooga. It's a very walkable site. Okay, on to Jackson, Mississippi. These are two kind of high-rise buildings that have been vacant for a long time. One of them is a King Edward Hotel. Both of these were done by HRI out of Atlanta, New Orleans. Their specialty is buying properties like this, getting a lot of the historic tax credits and working through all these programs to redevelop these old buildings. King Edward Hotel is right downtown. It was a large project, $84 million, with a lot of different funds, some of which were the tax credits. The property stays, there's a lot of young professionals there, legislators and whatnot associated with the government are living there. So there's some kind of before and after picture for you. At one time, this was totally vacant. There was, even some of the floors were you could see nothing but steel beams. Standard Life Building, similar story, same developer. They're building 31 apartments and about 31,000 square feet of vacant retail. It's underway now. That's another big project, $33 million. Okay, so we'll go to Birmingham. Birmingham's got a lot going on downtown. I've lived in Birmingham for 7 years, and since I've been there, it's amazing the transformation that's going on there now. This property right here, Cityville, was really what got it all started. This was built in the teeth of the recession, and nobody thought it was going to work. And it kind of took a while to catch, but mainly the slow part on the deal was 255 units with about 21,000 square feet of ground floor retail. The retail is what was the slow, what took a while to lease. As a matter of fact, it never really leased until it sold here recently. But that was a joint venture between Inland, which is a private REIT, and a local development company in Birmingham, Corporate Realty. It's an assemblage of several sites. A group previously had it tied up to build a high-rise building, which failed. And so they took on the project. They had some incentives from the city. Currently, the rents are $1.55 a square foot. It traded in 2014 at a 5.35 cap for $38.2 million. That was purchased by a Northeastern-based investment group with some kind of hybrid institutional money behind them there. So the success of Cityville really got everybody in town thinking, hey, this will work. And then we had a few other infill deals that in Homewood and around the Mountain Brook area that sold at low cap rates and high per unit values. And everybody said, well, if it's working everywhere else, we see that it's working here, let's go ahead and start building some more product downtown. Similar story to Montgomery. there was a lot of old buildings that had been renovated for condos. They didn't work. They rented them out, and then one day everybody woke up and said, wow, there's a bunch of people living downtown, and all the buildings are full. And then the South Side submarket, which is just south of UAB, which is all 10, 20, and 30 unit buildings, is full. Rents are going up significantly there. And so basically you have the two major job centers in Birmingham. You have downtown and UAB, and really nothing but kind of 1920s to 1940s built properties for people to live in. So it's all about to change. Now we've got a fair amount of units under construction. There's 4 projects underway now, or 2 underway, 2 will start here soon. This is just kind of a map, give you a better idea of what's going on. A lot of the development centered along the railroad park, which is highlighted in green. It's along the railroad there. On the other side, to the right of that side, is the minor league ballpark, which was completed 2 years ago. So you can see there's Live Parkside, which is, I believe, 210 units, is under construction now. Inland, the group who partnered on the Cityville, is building the property right by Regents Field. You can see it from the ballpark. And then there's 2 properties, Metropolitan and Bristol, are building about 500 units in the Lakeview district, which is all young professional, where kind of all the young professionals go out at night. And then there's several other projects scattered about this whole area. And when you get into downtown, some historic redevelopments that are in play that haven't really materialized yet, but should in the next 18 months or so. So.
Oh, are they high-rise or mid-rise or low?
Yeah, they are mid-rise. So this is the one on the left is going to be the Venue, which is the inland property near the ballpark. So it's all mid-rise. I believe the one on the left, the Venue, is a wrap deal. So you have the parking deck with units wrapped around it, and then the park side, which is on the right, is more of a podium where you have some underground parking and ground level parking, and the units are stacked on top. There's some retail associated with the Parkside development. They're penciling out, I think their rents are in the $1.40, $1.50 per square foot is what they're shooting to get. Here's an example around Birmingham of just some land sale or land value appreciation. These are sales that occurred from 2007 to 2014. You're seeing 2007, $38 a square foot, to 2014, $55 a square foot. So it's helping property owners who think they just have a dead building or site, and creating some value for them. That is end of the deal stories. But I guess there's several common themes with all these developments, like in Birmingham, all these markets, jobs in the city center. People want to live, work, and play, especially the millennials. They want to walk to work or ride their bike to work, and then making a safe environment. I know Birmingham has invested a lot in the CAPS program, which will come help you walk somebody to their car at night from the office. They'll, if you like your keys in their car, they'll come help you. So creating a safe environment, having a good nightlife and restaurants, which Mobile has here. Seeing the historic renovations are leading the way. Having city help facilitate these developments is key too, because these developments are hard. They take a long time to come to fruition. They're expensive, but we're seeing the rents that support them. And then the JV partnership. So with several of these instances, you had a local developer that had the site and maybe brought in somebody from out of the area to come and execute the deal because they're doing it in other markets, and bring maybe some financing or equity to the table. And then the financing part of the deal is also a major piece of the puzzle, and that's what Chad Hagwood can talk to you about. So, that'll never work, common theme. And, we're seeing it everywhere. Again, we cover a number of markets around the southeast or deep south, and it's working everywhere. We're seeing downtown multifamily either built or historic buildings converted, and it's pretty exciting to watch. So, that's all we got.
Thanks, Bo. I attended Millsaps College, which is not downtown Jackson, Mississippi, but it's in an adjacent neighborhood. And at the time, there were 0 people living in downtown Jackson. And I drove through recently and tried to get a tour of both of those properties he just showed, and they were 100% leased. So I did get a tour of one unit that had been pre-leased, but the tenant hadn't moved in yet. And it just goes to, to show to his theme that the projects, when done well, will lease. It just confirms that. So now I'm going to introduce Chad Hagwood. Chad is the Senior Vice President of Originations with Capital One Multifamily Finance, and he's going to shed a little light on how some of these complicated structures are financed and brought online. So thanks, Chad.
Well, the good news is you're one step closer to happy hour. The bad news is I've got 400 slides to go through. The other good news is I'm lying. We really appreciate the opportunity to be with you guys today. It's always a privilege to come down to Mobile. My colleague Jim and I were here a couple of months ago, and we were hanging out with Fred a little bit downtown. Had dinner, had a cocktail, watching the people walk around. There was a really good vibe going on amongst the community downtown. I was really excited to see that. And unlike some cities where you see a lot of this downtown development activity going on, your architecture is amazing. It's just an amazing city to look at architecturally. And no matter how many new developments come along, you just can't build that thing that was built 60, 70 years ago. And they're just pretty to look at. And I'm so glad to see so many of the restaurants and bars and taking advantage of that, because like we've seen in Birmingham, things that were dead 10 years ago that you'd never stepped foot in, people want to go there. There's been a couple of places over the past couple of years that I had no idea that were there, and now they're thriving restaurants, thriving bars, and the businessman took a risk. The small entrepreneur took a risk, and it's paying off. And again, I'm a huge fan of Birmingham. I'm a huge fan of Alabama. Always have been. And yeah, I would have said downtown Birmingham. Man, I don't know that'll ever work. But it's just amazing to see how much outside capital has come in, and not just from the debt side, but the equity side, the JV side, all sorts of partnerships from all across the country that 10 years ago they wouldn't necessarily be able to figure out where Alabama is on the map. But I'm telling you, I do business all across the country, and I'm very proud for our state to have an up-and-coming reputation. It's, tell me a little more about your multifamily market there. So it's always a trade-off. We want to keep it a little bit of a secret, but at the same time, we wanted to go north. So what I'd like to do is just give a 30,000-foot overview of the different financing structures that are typically available out there, and then of course we'll leave plenty of time for questions there at the end. But again, my name is Chad Hagwood. I'm a Senior Vice President, Regional Manager for Capital One Multifamily Finance. We were formerly, my group was formerly known as Beach Street Capital. We sold ourselves to the bank. We closed that merger November 1 a year ago. So I'm still getting a little used to saying the Capital One name, so if I slip up, please excuse me. But We are a national lender specializing in all financing of all product types. I do office, retail, blah, blah, blah. But one of my favorite things and one of my niches is multifamily lending. As Bo said, multifamily, it's very much the hot segment of the major food groups. Just a couple of stats here. Loan originations up 47% from 2012 to 2011, and 2013 increased another 15% above 2012. Don't know where the numbers are going to end up by the end of the year this year, but I can tell you they're going to be more than last year. Ironically enough, it started out a little slow on the debt origination sides at the beginning of the year, but it has since come back hard and heavy. Since 2012, on average, the prices per unit have been above the 2000 peak prices before the crash, and that's for primary and secondary markets. You know, again, I'm a glass, the glass is half full guy, but is that a warning sign? Fannie and Freddie, who are major players for the multifamily finance market, as you know, they had record years in 2013, and they're going to have another record year in 2014. Interestingly enough, Fannie Mae has always been the larger of the two lenders, but this year there is a fairly decent chance that Freddie Mac will actually beat Fannie Mae on the multifamily lending side. Portfolios, the delinquency rates are virtually non-existent. Very few REO deals left in their portfolio, if hardly any. If it is, I bet you can count it on two hands. But the delinquency rates are extremely low. What are the general lending parameters? And what we're talking about now here is after you get your new mixed-use development up, or your new multifamily unit up, what can you come in and take the bank out with? Well, these are the general parameters for the agency loans, up to 80% with a 125 debt service coverage ratio. Typical terms are 5, 7, and 10 years, the majority of which is a 10-year term. It's, you know, frankly, where the borrower gets a little bit of a better deal. It's where you can push the leverage a little bit more. There are just certain underwriting constraints with shorter-term deals that I won't bore you with right now. Amortization periods, 30 years. 30 years is pretty standard, certainly on a new construction deal. And on that, you get a little kicker with interest only. A couple of years ago, it was very difficult to get a lot of meaningful interest only on a perm loan with Fannie or Freddie. Right now, you can get a couple of years without trying too hard. And in some cases, very strong markets with great sponsorship, I'm seeing up to 5 years interest only from the agencies on full leverage loans. Your typical rate today, if we were locking a rate as we set today on a down the fairway multifamily deal, about 4.10%. Again, a very aggressive deal today for the right sponsor in the right market. Can you get under 4% on 10-year money? Yes. Prepayment penalties, always going to have a prepayment penalty. Yield maintenance for Fannie, defeasance for Freddie. Underwritten reserves, even on new properties, generally about $250 a door that certainly you need to take into account when you're running your models and your pro formas. Recourse, non-recourse. No guarantees except for the bad boy provisions. What are the bad boy provisions? It's basically things none of you are ever going to do. Burn the property down, run off with the insurance money, that kind of thing. Second mortgages. You come in, you build your project, you take it out with the perm loan. A year later, you have just knocked the cover off the ball with your rents. You're achieving what more than you thought you were going to achieve, and you can come back during the term of that loan and take a couple more bites at the apple and take a supplemental loan out and recast your loan back up to 80%, 75% of the new value. CMBS. Obviously, CMBS has been dead for quite a while. since July 1, 2007 to be specific. And it was a very, very big component of the overall market back in 2005, 6, and 7, not only for multifamily, but for office, for retail. It played a very big role. And then on July 1, amongst everything else going on, the light switch literally turned off with this particular market segment. The loans couldn't be securitized, you couldn't sell them, no one knew what the risk premiums needed to be, and it just really, really dried up, which severely hurt the commercial real estate lending activity. CMBS, borrowers that have nicks on their credit history, lesser quality properties, smaller markets, older properties, blah, blah, blah. You know, this played a role for those type of properties. And the market share for this type of business just dried up. But over the past 3 years, you have seen that piece of the pie become increase itself every year. This year, I think they will have the biggest year loan origination wise since 2007. There have been 3 years where CMBS originations, loan originations, all property types, were above $100 billion. 2005, 2006, 2007. And we'll be above $100 billion in CMBS originations in 2014 before it's over with. So, you know, again, glass half full, but that's a little spooky to me. Current rates for 75% leverage, 30-year amortization, you're in the 425, 450 range. One advantage is they're pretty daggum generous with the interest-only components, and that's how they are competing with the Fannies and the Freddies, that they're willing to churn out a little bit more of the interest-only turn, even though their rates are not as competitive, to entice the borrowers to come back and give them another try. Prepayment is defeasance, reserves, generally the same as Fannie and Freddie. They are non-recourse, second mortgages, you can't have them. In all honesty, these transactions are needed. They're needed for a lot of borrowers. They're needed for a lot of properties. And the benefit of what I do, I'm not trying to cram a borrower into any one specific program, but some programs are just going to work better for some borrowers versus others. There's some borrowers of mine that Freddie will never let go to Fannie because they want their business so bad. They're going to buy the business, and vice versa. And there are some folks that either properties, or because they've had a couple of deed and lieu's, or they've got some properties that are struggling, you know, the CMBS market is filling that void. But they are more difficult to get done. They are more difficult for the borrower after it closes. The documents are a little more onerous, in my opinion. But it's a trade-off. A lot of times, I won't say all the time, but I would say 80% of the time, you're going to get a little more proceeds out of it. You're going to get a little more interest only out of it. And to some folks, that's an important part of the deal. So that's what I probably should have moved this slide up first, but nevertheless, it is where it is. So construction terms, what's an average construction loan? Well, obviously it's going to vary greatly depending on your locality, who's in your region, so forth and so on. But as an average, I think these are pretty accurate construction loans for multifamily with some mixed-use component, you know, be it office or retail. 75%, I think that's pushing the leverage level for most banks, unless you have an incredibly strong sponsor. Typical term, 3 years. Maybe 5 with a rate review and some extension options, obviously interest only. Looking at survey of what closed over the past 60 days, average spreads over LIBOR, floating rate, 195 to 250 basis points over LIBOR, and LIBOR is still sitting around 15 basis points. So at least going in, you know, it's pretty close to free money. Obviously, it's recourse. There are non-recourse programs out there from banks, but they're lower leverage, and that's important to some borrowers. They can make that work at lower leverage. But non-recourse, full leverage, 85% construction loans. I kind of call that the unicorn program. I haven't really seen one yet. Construction to perm, I always get a lot of questions about what's out there for a construction loan that will immediately roll me into a perm loan. And yes, there are several of those programs. The one that most people I would say are familiar with is the HUD 221D4 program, which again is a program that very much serves a need. It is a fantastic program as far as rate, non-recourse, 40-year AM, and it's full leverage. The downfall is you're going to kill a bunch of trees and a bunch of time. And if it's something that you need to get out of the ground in 12 months, forget about it. It's just, again, it's a unicorn. You can't do it. It's realistically a 18, 24-month process. And actually, now that we're coming into the holiday season, it's about a 30-month process, because I think they're gone the entire month of December and January. If you're looking at a mixed-use deal, I just wanted to run a couple of stats by you for retail. If you're looking at something with a retail component, retail, obviously the sales are up from year over year. We did see a lot of capital flowing from larger markets, chasing yield in smaller markets. A good cap rate compression on retail, which we have not seen in quite a while. Generally speaking, we saw the vacancies decline, but we all know that retailers are still a little cautious of expansions. Similar story with office. Office originations grew 22% 2013. The banks were 33% of this volume. CMBS, again, from 2 years before that, going from virtually nothing to 25% or so. And life companies accounted for about 18%. Cap rates, secondary and tertiary markets did compress, but in a market, say Mobile or Birmingham, it's still a decent premium compared to the Atlantas, the Dallases. Absolutely more capital is out there with the office and the retail side, but one note of caution is Bo alluded to, in the projects that I've been involved with, where it's predominantly multifamily, base level retail, the retail component 8 times out of 10 has really held that multifamily component back. It's been very difficult, even in larger cities, to lease up a lot of this retail. And from the perm standards with Fannie and Freddie, no matter if you lease it overnight, you're still going to be hit on the underwriting side. By law, Fannie is there, Freddie is there to lend to single individual, provide housing, not shop space. So any more than 20% of EGI, you really start running into issues with the best takeout financing, in my opinion, on the multifamily side. That's not an issue so much with CMBS. It's not an issue with so much with life company financing. But just be mindful of that as you start investigating your projects. And here's just a quick summary, recap of what we discussed as far as general lending parameters for commercial properties, office and retail. Quick chart, just showing where we've been and where we are on what's happened to the cap rates over the past over the past 6, 7 years, 8 years, and you can, you know, you can see the ugly days versus where we are. Delinquency rates. This is always a horrible chart to look at, but it's good to see where we are again versus where we've been. Next chart is just a summary of the 10-year Treasury, which is the primary index used for most permanent real estate loans. 10, 7, and 5-year Treasury. Take the 10-year today versus its low from 2013. It's about a 45% increase, but obviously if we took that chart back 50 years, you know, you would still see we're at the bottom of the trough. Here's again, something that bothers me just a little bit. 1.7 trillion of commercial debts maturing between now and 2017. And that's all lending types, whether that's agencies, CMBS, all banks, pension funds, life companies, so forth and so on. Obviously, a lot of that was done between 2005 and 2007. CMBS, about, call it 500 billion, and 770 billion of this is bank debt, which is probably why you hear more and more why banks are ratcheting in their credit policies these days. Another stat, in 2012, of the CMBS debt that was outstanding, only about 76% of that could refinance out with perm debt. And of the most recent information available, and it's going to vary depending on who you ask, but it's estimated only that 50% of the loans that closed in 2006, 30% that closed in 2007 can actually refinance out right now. So it works a heck of a lot better where rates are today, but one little bump in rates and it just makes the problem a lot more harder to deal with. This is a summary of who does what. Agencies, again, Fannie, Freddie, FHA. Life companies, others are private pension funds, private REITs, the commercial banks, and then CMBS. So what are the perm lenders looking for? And really these criteria aren't going to vary dramatically from construction to perm. But you want to see a market that's growing. Mobile's got a great story. It's got strong rent increases. You've got a lot of demand for the product. You don't have a lot of new construction. So Mobile has got a good story, and frankly, in the state, it's actually one of the cities that has really one of the better stories in the state. Again, the sponsorship, I can't stress this enough. The rule in 2005 was if you could fog a mirror, you're going to get a CMBS loan. But it has become more and more important, critical, that the lenders are, pardon my colorful metaphor here, but it is certainly more of a proctology exam today than it was, several years ago. And, a lot of times the bar will ask, why in the hell are you asking for this? I'm like, I don't know, but it happens, and you have to check the box off. And there's a lot more nonsense, but just remember, it's not your loan officer that's making you do this, it's Uncle Sam. large volume of maturing loans. We talked about those, but at the same time, glass half full, I think that should also be a buying opportunity. You know, when this stuff starts coming up, if we save our pennies for the rainy day, if you've got that good track record, you know, I assure you, there's going to be somebody out there that you know. Hopefully, you don't like them, but there's an opportunity to get a deal. We don't want this to happen to our good friends, but that guy who won't pay the full origination fee, you know. Fannie and Freddie, they're going to continue to dominate things on the multifamily side. I don't see that changing this year. Certainly, I don't see it changing the first part of next year. But again, if everything stays competitive, I've seen this before. I can see that piece of the pie that the agencies have transitioning, just like it did from 2002, 2003, and 2004, the same as it did with CMBS. Underwriting standards on the properties, they've definitely loosened from the CMBS side. I would say, you know, personally, I think that they've loosened a little bit from all fronts. Not so much with HUD necessarily. It's more about, you know, boxes than dive deep into the numbers. But it's I've seen a little loosening, in my opinion, from all fronts. We have had some volatility in the market, obviously. Who knows what it looks like, you know, over the balance of the year. Next year, your guess is as good as mine. I love Mobile, but again, if I knew what rates were doing, I wouldn't be here. I'd be on the beach somewhere. But, you know, one thing is for sure, if you look at the history, you would have a hard time convincing ourselves. Yes, you might pick up 5-10 basis points here and there with rates, but it's a statistical fact. You've got a far better chance of having a higher rate a year from now than you do having a lower rate. So I would say things that are on the horizon, things that you're thinking about, you know, get them up, get them going, get them out of the ground, and put them to bed, and move on to the next. I'm done. Thank you, guys.
So one of my takeaways from that was that based on the economic development successes of Mobile's had over the last few years, there's the fundamentals with job growth are certainly an asset for downtown multifamily. So I'd like to take some questions for our panelists, see if they can answer any questions you have about anything that they mentioned today. So any questions? Yes, ma'am.
I would say for, you know, Pensacola, there's very few true urban deals. What is close to the city is garden-style apartment complexes. And I would say that the rent per square foot between a similar vintage property in Mobile and Pensacola, they're basically right on top of each other. Mobile, to me, performs a little better because there's frankly, one, I think more demand right now. There's a lot more going on, and Mobile's been a little more judicious over time with its new development activity.
What were the other
cities that you mentioned?
Rents compared to regionals,
What other cities?
Gulfport, she could be Gulfport.
you know, Lori, you know how you cover quite a few different cities with your same research. And what I want to see is what our regional, how we compare to the other regional cities around us that you may work with, as far as rent potential.
Right. Well, I've done all those studies over the past 10 years, so it'd be hard for me, unless I did them all at the same time, to make an actual valid comparison. But my sense is that in most cities, the rents per square foot don't come close to covering the construction and developer costs, and there's always a gap. I don't know how much that gap is here, but I'm sure there is one. But my sense is that none of them are above, on average, $1.50. I mean, I'm sure they're probably more like $1.10 to $1.25.
I think Gulfport, I don't know they have very much in the way of
Down there.
supply in their Biloxi or Gulfport or Biloxi. Most of it's just garden style, bread and butter, multifamily. They may have one or two, but nothing of any substance.
But if you look at, say, Birmingham 7 years ago, you're not going to find too many complexes that had an average rent above $1.25 a foot. And the Cityville deal that Bo showed, which was really our first urban deal downtown, it blew through $1.60. The real rents today are you probably pushing close to $1.75 a foot, and that is absolutely unheard of in Birmingham before. And so it kind of set this high water mark, and I think Bo would agree. It's kind of been amazing that all of a sudden now, even with what was the Class A, and we would have said we're pushing the rents 5-6 years ago. These city deals that are the urban deals are close to being at the city have just blown the rents through the roof.
Yeah, I think the two projects that are underway now are, were penciled out at around $1.50 or so a square foot, and the next wave is like $1.70, $1.80. And part of that is their land cost is a bit more. Part of that's construction costs are more, and so they've got to make it work. But part of it is they've seen it work in other areas and feel confident the project's going to work at that level. So
The other thing is, while you again get it out of the ground, get going, and get great debt on it, so you can sell this thing very quickly, because these other deals that we're referencing, they've also set the record for the lowest cap rates on sales over the past, and for the state in the past 24 months, 18 months.
Yes, sir.
Not so much a question as a comment, but it seems like in every city that we've worked in, there's been some catalyst, either person or event, that's caused the dominoes to begin falling. So in Montgomery, it was Foshi in the city buying dilapidated properties and selling them at a loss to developers who agreed to develop them. In Birmingham, it was Inland and Corporate Realty taking the chance to be that first. But he's the Corporate Realty guy, by the way. Is he also the same guy that brought the baseball park downtown. So these are people with vision who were well rewarded when they took the chance.
Yes, sir. Any other questions? Yes, sir.
Bo, you mentioned that in a number of the projects, cities either provided ground lease or did a little something here or a little something there. How much have cities been involved in these to make them successful?
more than you would think. I can't give you like a exact ratio, but there's, again, these are very complicated projects sometimes that involve either site issues like environmental or subterranean type issues that are going to drive the cost a lot, or parking is a big, I think I saw Jim Nevins in here. He'll tell you a parking deck will really increase your per unit cost on an apartment development. So having that type of support from the city, whether it's helping out with the cost of a parking deck or streetscape just to enhance the the appeal or walkability of the project is key. So I mean, is it necessary in every project? No, but I mean, in some instances, it's going to help, and I think there's a reward for it later on.
Following up on that, is there a rule of thumb, like a percentage-wise rule of thumb that you've seen, maybe a per unit contribution, or 2%, 5%, 9% kind of ask from developers with those creative partnerships?
I don't know.
Of course,
If
sure.
they just want to build, cities can build all the parking decks, that'd be great. I think all the developers would be happy with that.
I was watching an interview with Eric Schmidt the other day, and he was talking about the impact that driverless cars are going to have on this, this whole parking situation, and I wonder how that's being factored into projects that are on, under consideration now, because we don't know exactly when that's going to blossom, but it is going to blossom as an option for people.
The what now?
Driverless cars.
Well, and certainly for young people, more and more of them are using bicycles as their primary mode of transportation, which definitely reduces the requirement for parking spaces. It's hard to underestimate or overestimate the number of parking spaces required. A lot of it has to do with how much public transportation is available and how many alternatives you have, like, rent a car for an hour.
Right. Car sharing. Technology's really going to drive that. You hate for cities to get stuck owning, $20 million worth of parking garages, because technology's changing so fast in terms of how people are using transportation in a totally different way from the last century.
Yes, sir.
What role did, I guess I'll call it cultural infrastructure, whether it's grocery stores, bars, restaurants, and the like, retail, how does that drive the developer's decision to be in a certain location? And does the cultural infrastructure come first, or does it come after the residential development?
I think it's a combination. I know in Birmingham, everybody kept, one of the, this will never work, as well, there's not a grocery store anywhere downtown. And what happened is people just learned to just drive a little bit further to go to the grocery store, and you ask anybody who lived downtown, and they didn't really care that they had to, drive 5 minutes to the grocery store. Now, ultimately, there's a project underway now, or they're raising money for it, for a Publix in downtown Birmingham. So it's more of, first you got to get the people down there, and I think what's probably more important than a grocery store is just having the parks, the nightlife, the walkability. You want to just have people to give them a reason to be downtown, other than the grocery store, and all that will come later on. And I know in Birmingham, it does not seem like the outside development world was just, or before all this stuff really took hold, the grocery store was a big question mark. But as everything progressed, it really kind of got shuffled to the side, and it wasn't a big deal. So
I think you've seen in a lot of cities, it really just depends on the city, and some cities, say Charleston, for example, there's so many historic and cultural things there that the newer things have built because that's already there. Whereas, again, in some of the other cities, it's the old stuff was dilapidated, but it's got a new breath breathed into it.
We found that people come first, unfortunately, for developers who are looking for a location that has all those amenities. But certainly for young people who are basically the urban pioneers, they will move into neighborhoods and downtowns that have very little in the way of amenities, but because the whole urban context of a downtown, which is a direct contrast to suburbia, is the kind of physical environment they're looking for. The more people living there, the better as far as they're concerned. But many of our downtown studies have been conducted at the behest of the business community and the retailers in the downtown. We said, look, we can't survive on the 9 to 5 population. We need downtown to be a neighborhood as well as a business center. And once there are a sufficient number of households, the retail does come. Grocery stores are hard because most of the national chains don't have a real urban model. And an urban model is really what's necessary because an urban resident doesn't want to go to the grocery store and see aisle after aisle of paper towels. They're looking for, little boutique style grocers within the grocery store where they can pick up already cooked stuff.
Well, piggybacking on that, do you see a preference for the residential users to be closer to the social amenities or to the office drivers, or is it a balance? All the above?
It really depends. Obviously, if you have waterfront, that's just a human desire to be able to look at water. But certainly, in the downtown core, young people in particular want to be where the action is. And it doesn't necessarily have to have the kind of bars that they want to go to, but if you do have those, that's even better. And a lot of them will evolve after there's a significant downtown population.
Seems like a new amenity is the coffee house.
Yeah, definitely the coffee shop.
Coffee house there, everybody.
That and cocktail bars.
I think on most of the new construction you've seen on the in-town product is the developers are trying to build and put as little commercial space in there as possible, because what they saw is in the first kind of wave of this, there was way too much, and as Chad noted, it was the dead weight for the project. So they're trying to figure out, solve, how do we put just a small amount of commercial space there instead of commercial space. They'll try to make another amenity for a fitness center or something.
And Bo, I think we talked about this a little bit on the phone a few weeks ago, and I wonder the Belk Hudson rehab, and you noticed you said it's all residential. There's no commercial in that building, even on the ground floor in what looks like these enormous display windows.
That's
The
their
people
fitness area.
live there.
Yeah,
The
that's-
fitness
that's
area.
the
And parking is in there too. A lot of cities require that the ground floor be retail, which creates a real problem, because then you wind up with a lot of empty ground floor spaces, which is no more attractive to walk past than a parking lot. So, I know the city of Grand Rapids in Michigan has now a live-work variance that doesn't mean that you actually have to have your office space or your art gallery, but there should be part of the dwelling unit on the ground floor that is used for business purposes. So it could be your office, home office. But that's a real challenge, because obviously you want retail on the ground floor, but particularly with new construction, a lot of the retail uses in the downtown could never afford the new construction rents.
The ground floor has really struggled here.
Yeah.
People have not wanted to live in those ground floor units.
They don't want to.
Try to convert to, office, kind of light office use. People have not, right on the.
Maybe when you
right
get
on the
more
stars.
people living downtown, the ground floor will become more desirable, because we've certainly seen that in other cities. Depends upon what the traffic is, but I haven't seen any of the downtown streets that look like super highways in terms of traffic.
I was able to dine with Lori last night, and it sounds like she has done a lot of work in Michigan lately. And she was telling a story about how in Grand Rapids they just changed the law that a brewery license costs $85, and so the community was trying to reinvent itself as a hub for craft brewing, as a
Now
new
known as
community
the beer
development.
city.
I saw a hand back there.
I was just wondering whether you see in your studies where these urban pioneers are moving into these multifamily units and downtown spaces. Does that lead to a a decrease in crime rates, or is there just a higher tolerance for some level of unsafetyness among the urban pioneers that do live in these?
Oh, yeah, no, they don't care about the same thing. Yet millennials do not care about the same things in that respect as baby boomers. You know, baby boomers are the ones who do want to be escorted from, you know, the car to their door. But the millennials, they don't care. I mean, it's a really interesting generation. It's the most diverse generation in American history. It's the first generation in America where whites will be the plurality, not the majority. And as a result, these are very tolerant. They don't view anything in the same way as baby boomers do. So they're much more interested in diversity of everything. I mean, I've seen some of the scruffiest buildings become, you know, illegal lofts. I mean, that's how Soho started in New York City in the 70s. Was just, you know, artists and drug dealers moving into the upper floors of these empty warehouses. And pretty soon it became pretty cool, and New York realized it. And they do have a J51 tax credit, which is very helpful to developers. And now it's, you know, one of the most expensive places in America. But boy, in the 70s it looked pretty grim.
Well, are there any other questions? Yes, sir.
Yeah, so in this presentation, my takeaway is interest rates are fantastic, downtown is like going for it, rents are high, a lot of people, everybody wants to move downtown, a lot of pros. Quite simply, I'm not so into construction costs, so I'm not sure how the math works, but is it financially a great idea to build on a lot downtown, a residential unit? Well, not just a residential unit, but a development. I mean, it sounds like we're talking about how positive everything is, but you know, it hasn't taken place yet.
Well, I don't know what construction costs are here.
Sure.
I mean, that's something we had to give up years ago because it's just so different from place to place.
Right.
So what we give is to the potential developer is where the market is in terms of rents and prices. They know how much it's going to cost
Sure.
to do it, and there's generally a gap, and that's where the incentives which come in terms of building the parking deck or, you know, allowing the land as a land lease, or, you know, and also improving the infrastructure. I mean, that is a huge incentive to developers. And in some of them, in some cities, you know, the city even takes, you know, a share of the risk. But it varies from place to place. But it rarely happens without some sort of city participation. If it only means like St. Louis and Kansas City went to and got state historic tax credits, which I gather Mobile and Montgomery did a couple years ago, to help with the redevelopment of older buildings. That was a huge step in turning downtown St. Louis from an empty place to one that's really filled with lots of housing now.
Well, yeah, on that point, you have a good question. That's the whole risk reward. So, you know, it's expensive. You can't go say, hey, well, you can go build a deal in West Mobile or over on the Eastern Shore, a surface parked, you know, garden style apartment community for $115,000, $120,000 a unit. You're going to have to throw that out the window because you've got, you know, what if you have to build a parking deck? What if there's so many different variables, but what you are seeing is that, you know, one thing is a trade-off is your units are typically a little bit smaller than what you would build in say, a suburban type setup. And so your per unit or per foot rents are going to be higher. And I mean, what I think we've all talked about here is that the rents are supporting that new development. I mean, would think that it would work here. And maybe it's not a new development. Maybe it's buying an old building, because there's plenty of really great historical buildings here, and starting there and assembling a site here is very hard to do in Mobile. It's hard to find. 3 or 4 acres to build some type of mid-rise. Assembling several, 10 units here, 10 units there is probably the best starting point until somebody who owns a parking lot wants to decide they want to participate in the game.
I think that's also why you see so many of these partnerships and even tax credits and so forth. What is a little too risky for you might be well within reason for a larger JV partner. Or once you utilize your tax credits, then it takes the sting out of it. But if you ask me what I think the cons are, well, it always comes at the sacrifice of something. And I don't know too many markets in the United States right now where the job growth is just blowing it out of the chart, unless it's Washington, D.C. Right now, when we pro forma everything at rents that we would have thought were Jules Verne rents for Alabama 5 years ago, well, I think that's something, I'd be a little cautious of. I would say that if you're basing, your takeout financing on rates that have historically never been achievable, that we've never seen before, I think that's probably a little bit aggressive. I would say that if you're assuming that you can get the 5% cap rate or the 4.75 cap rate because the guy down the street did when he had a 2.5% HUD loan on it, I'd say that's a bit aggressive. And I think, there's a hell of a lot of demand for these type of units in downtown Mobile and in Birmingham. But without massive job growth, then it's going to come at the detriment of something. And some of the older properties in suburban markets where the millennials do live, those are the ones I'd be a little concerned about. The new properties, I think the new Class A stuff, garden, suburban, I think they're going to do fine. But we need to find out exactly what all complexes the millennials are living in right now and go short those properties.
A lot of them, their parents' houses.
Good point.
It's already been shorted.
I saw another hand raised.
Yeah, that was kind of my question. I wanted to know if you knew if there was a different demographic for the people who buy in downtown and the people who rent, and if we take the people that rent from the area that already has product, which would be probably freestanding houses, and we build a new product, are they going to then leave that to go to the newer and leave the rest there? And then do we have people to fill those spots that would buy but just don't have the inventory? In other words, are we going to take from a rented market?
Right, that's
For
assuming
homes.
it's a zero-sum game.
Assuming, right.
Right, but
Is
it's
the
not.
growth potential people additional, or is it from just people that would move around and?
No, you wind up with net gain
Okay.
of housing units, because there is a net gain of households, of people coming from outside. What happens is you have, in every market, you've got, the first-time buyer, the move up, move down.
Right.
What we are a bit concerned about is the first-time buyer, because that has typically been young people. And young people are not buying houses at the same percentage as predecessor generations, because the average college debt for college-educated kids is $30,000 now, and that, would be a nice down payment if they didn't have that loan to pay off. That's deterring a lot of them, besides having witnessed the carnage in the housing market over the past several years, has just made them decide ownership is not for me. And when you add to the fact that they're very mobile, they don't want to be tied down, the whole idea of buying something with a mortgage becomes less and less, what they're choosing to do. So certainly, right now and for the next few years, we're looking at mostly renters for young people.
I'd say one demographic we hadn't talked about much is there's a lot of empty nesters and retirees that are living in these, infill type properties. We've seen
They're moving out of their house to get away from their kids.
right. They're scaling down. They don't, maybe they have a house at the beach or have a big house. Or, they want to forego the payment and they want to be in the mix with everything. So you're seeing that. We've seen several properties where they've totally switched their marketing from a millennial, based type strategy to going after empty nesters. So.
Well, are you seeing them more in the historical redevelopments or more in the modern type with the upgrades and the amenities for the empty nesters?
Probably more the modern, but some of both. The receptionist at our office, she lives downtown. Her and her husband. She's kind of retired, but doing this is another job, and she loves living down there. She lives on a loft in downtown Birmingham. So.
A lot of them are condo buyers, and now they're all cash buyers, so that means they had to have sold the house they were living in, the single-family house. If they can't do that, that kind of, that has shrunk the empty nester market to a certain extent. But there are a lot of them that choose to rent too. The whole issue is to be able to lock and go, and not have to worry about, what's happening to the house when they're gone.
That's great. Are there any other questions? Well, good. Well, we're now, I want to thank our sponsors, MMI, Multifamily Management, Willis Insurance, Walcott Adams, Capital One, Hand Arundel, Hunter Ventures, Burton Property Group, Trustmark, The Rock, Phelps Dunbar, Volkert, Cummings and Associates, Goodwin Mills and Kaywood, Heritage Homes, Jubilee Scape, McElhaney Insurance, Millen Commercial Real Estate, Rogers and Willard, Vallis Realty, and White Spunner Realty. So thank you. And due to their generous support, we're going to be able to enjoy cocktails downtown and snacks from a number of our downtown restaurants. Additionally, we're going to have a tour at 5:15 for anybody interested of 304 Government Street, the vacant Press Register building right next door. So it's a wish list. Hopefully, it's on our wish list for a pipeline project. Hopefully, someone will be inspired by it. So thank you all for coming. Let's have a glass of wine or a beer and network.